fast, where truth moves faster than a Holstein calf. No waiting on some pretty page. We're charting new ground in the digital age. From genomic codes to roll-out facts, we cut through the noise, no holding back. Not your daddy's dairy news tonight. We're sparking debates with every insight. The ring's not where the real fight's at. It's in the data, in the channel chat. From pasture to processor to your morning cup, we're raising the stakes. Try and get ahead of herd. Yeah! Where the future's more than just a word. Ahead of herd. Come on! The bullvine's calling, let your voice be heard.
Welcome to another episode of the Bullvine Podcast, where we cut through the noise and get real about what's going on today in dairy farming. Today, we're digging into the roller coaster ride Australia's dairy industry has been on since deregulation in 2000. Massive farm exits, giant herds, wild price swings, and what it all means for us here in North America. Grab your coffee, get comfortable, and let's dive right in.
Welcome back to The Deep Dive, the show that digs deep into the topics that matter to dairy producers.
That's right.
Today, we're doing a deep dive into a really thought-provoking article from the Bullvine. It's all about what happened when Australia deregulated its dairy industry.
Yeah, and it's a story with some really stark lessons, I think, for dairy farmers pretty much everywhere, but especially here in North America.
Absolutely. This isn't just, abstract economic theory we're talking about.
No, not at all. It's about real numbers, actual farms, and frankly, the incredible human cost that comes with these huge sweeping policy changes.
Mm-hmm.
The insights from Australia's experiment, it's been, a quarter century now? They should really make anyone involved in dairy production just pause and think.
Yeah.
And the article, it draws on sources like the Abraze report, that's the big government study on deregulation.
Yeah.
So it's well-grounded stuff, it's compelling, and honestly, pretty sobering. We're going to break it all down.
Okay, so the stage is set. Let's really peel back the layers here. We need to understand the ripple effects, right? From the cold, hard cash farmers were, or maybe more accurately, weren't making,
right,
to the massive shifts in market power, and then the profound, often really heartbreaking impact it had on entire communities.
It's a story that directly informs your choices. For anyone listening, it helps us understand the future of dairy. It doesn't matter if you're shipping milk in Wisconsin or, Alberta.
Exactly. We want you to walk away from this deep dive with a much clearer picture of the potential consequences, the ripple effects of these kinds of policy decisions.
Precisely. What we're looking at here is it's a potent case study. It gives invaluable foresight into the challenges, the dynamics that can pop up when a heavily regulated industry suddenly shifts gears, goes more towards an open market.
It's about being prepared.
Yeah, understanding the levers at play so you're not just caught completely off guard by these unintended consequences.
Okay, so let's dive in. Section 1, the shocking bottom line. We have to start with the number that, honestly, the article's author says keeps them up at night. $2.46 an hour.
Yeah.
That's what some Australian dairy farmers were effectively earning during the worst times right after deregulation hit in 2000.
And it's crucial to understand that wasn't like a paycheck they got.
No, not at all. It was a calculation, right?
Right.
Based on a brutal combination of things. Think about it. They crunched the actual number. The milk prices just tanking. The relentless rise in input costs, fuel, feed, vet bills, everything.
All of it.
And then those brutal 70-hour weeks. Every dairy farmer listening knows exactly what that feels like.
Oh, yeah.
And when you factor all that in, for way too many farms, that's what their incredible hard work actually amounted to. It's a gut-wrenching figure.
It really is. It encapsulates that immense, just unrelenting financial pressure they were under day in, day out. It's not just a statistic. It's desperation.
And what really stands out here, I think, is that this number isn't just some anecdote someone told.
No, it's a stark illustration, backed by data, of the pressure you face when a regulated system just shifts, like overnight, to pure, unfiltered market forces.
Mm-hmm.
The Abraze report, that's the Australian Bureau of Agricultural and Resource Economics and Sciences, their main government research group, it really drives this home. It uses hard data to show the profound, often devastating challenges that real farm families, real communities were facing.
It highlights how fast the economic ground can shift under your feet.
Totally. And how utterly unprepared so many operations were for such a drastic, sudden change. This isn't theory. This is the lived, painful reality for thousands of farmers. They were forced to confront this, well, untenable financial situation almost overnight.
Yeah, the immediate impact was just this brutal recalculation, wasn't it? Is my farm even viable anymore?
Exactly. It forced so many to think about walking away from the industry they loved, the life they knew.
So what does this really mean for you listening now? This isn't just a number from down under.
No, it's a crucial warning, I think, for any system that's debating price supports or, major market changes.
It immediately sets the stage for why this whole story is so critical for Canadian farmers, especially with all the ongoing discussions around supply management here in North America.
And for our U.S. listeners too, right, who are already dealing with their own volatile markets. Australia's quarter-century experiment, it offers some really sobering insights about what can happen when you let pure market forces just run completely unchecked.
Imagine working 70 hours a week, pouring your life savings your whole life into your farm, only to find out you're earning less than minimum wage.
It's unthinkable.
This isn't some distant problem on another continent that has zero bearing on your farm. It's a potential preview, a glimpse into the kind of financial vulnerability that can emerge.
Understanding that baseline financial hit helps us grasp all the cascading effects that came next, right across the industry.
Yeah, it really frames the whole story of what happens when that economic floor is just pulled out from underproducers, leaving them totally exposed to every single market swing.
And it also fundamentally challenges that assumption, doesn't it? That deregulation automatically leads to better outcomes for everyone involved.
Right. Consumers might see lower prices on the shelf, initially anyway, and we'll get to that.
Yeah, we will. But the article makes it crystal clear that the true cost, the often hidden cost, is borne disproportionately directly by the producers.
That $2.46 figure just speaks volumes about the utter unsustainability of that kind of system for the primary producers.
And it makes you ask, well, who really does benefit from such a radical shift in how the market works?
The immediate impact was that brutal reevaluation, forcing countless farms to face an impossible choice, try to operate on margins that just weren't sustainable or walk away.
Okay, so moving on from that initial shock.
Yeah.
The earnings hit. Maybe the most striking transformation the article covers is just the sheer scale of farm consolidation.
Yeah, the numbers here are truly eye-opening. It absolutely brings home that phrase we hear all the time in ag, get bigger, get out.
Definitely. So back in 2000, Australia had nearly 13,000 dairy farms. Just think about that number for a second. A really thriving network of producers.
13,000, wow.
Today, just over 2 decades later, they're down to roughly 4,500.
4,500, that's a 65% drop. It's massive.
65%. We're talking about more than 8,000 farm families who, in many cases, had to walk away from farms that had maybe been in their families for generations.
It wasn't just a small adjustment. It was a wholesale exodus, a devastating pruning of the industry.
Imagine the cumulative knowledge lost, the family legacies just gone, the countless hours of labor that simply disappeared from the sector.
Now, zooming out a bit, proponents of deregulation, they'd argue this is just market efficiency doing its job, right?
That's the argument, yeah. Resources are being reallocated to the most productive uses. It streamlines the industry, makes it more competitive globally, supposedly.
And to be fair, the article does note that the farms that did survive became dramatically more productive, often probably out of sheer necessity.
Right. The data backs that up. Average herd sizes went from, about 168 cows before deregulation?
Yeah, pretty modest.
To a significantly larger 534 cows today. That's a huge jump.
3 times bigger.
And individual farm milk production, that saw an incredible increase too, up by a remarkable 570% since the late 70s, although that's a longer time frame.
Okay, so that definitely paints a picture of, individual farms becoming super efficient, driving output per cow, per acre.
But then this is but there's a crucial paradox here that the article really digs into. This is where it gets fascinating.
Right. Despite all this individual consolidation and efficiency, farms getting 3 times bigger, cows producing way more milk per head, everyone adopting the latest tech, robotic milking, advanced herd health software.
All the bells and whistles.
Despite all that, total milk production in Australia actually fell. It dropped by 26% from its peak.
Fell by a quarter. So you have these farms, 3 times bigger, cows producing more, all the latest gear. And yet the country as a whole is producing a quarter less milk than 25 years ago.
That's not just a minor blip in the stats, is it?
No. It challenges the whole idea that this efficiency led to an overall healthier, more robust industry.
It suggests that just scaling up isn't automatically a sign of growth. It could actually be a symptom of a shrinking industry where individual farms are just forced to become hyper-intensive simply to stay afloat.
And that raises the important question, is that truly efficiency? Or is it an industry contracting, forcing individual operations to become hyper-intensive just to survive in a much tougher, much more volatile market?
The article really leans towards the latter, doesn't it?
It strongly suggests it. It points out this isn't necessarily a sign of a healthy, growing industry, but more a symptom of one that's shrinking, where only the most aggressive, the most capitalized, the most efficient individual farms can actually stay solvent.
And when total output falls, even though individual productivity is way up, it tells you that the rate of farms exiting, it just far outpaced the growth of the ones left behind.
Exactly. And it could also imply, an increased reliance on external inputs, maybe a greater strain on resources, as these bigger operations push for maximum output in this high-pressure cooker environment.
It's a really critical distinction to make when you're analyzing the results of deregulation. It highlights a potential long-term fragility, maybe, rather than real, robust growth.
Okay, so after consolidation, what really gets me about the Australian story, and the article hammers this home, isn't just the falling farm numbers. It's what happened to the power dynamics all along the supply chain.
Yes. This is huge. The article emphasizes that when you remove price, supports those government-backed minimums that give farmers at least some baseline.
A safety net.
And you dismantle the marketing boards, which often handled collective bargaining and managed supply for producers. You don't just magically create a perfectly balanced free market where everyone competes fairly.
No, you create a vacuum.
Exactly. There's no longer a strong collective voice for the farmers. Individual producers are left pretty vulnerable.
And that vacuum, as Australia showed so vividly, it gets filled fast by whoever has the most leverage,
leading to this massive imbalance of power that just completely shifted the playing field.
And this vacuum you mentioned, it quickly became, a feeding ground for the big players with market dominance. We saw this rapid, really alarming concentration of power in a very short space of time.
The article highlights that by 2015, just 5 major processors' names like Murray Goulburn, Fonterra Australia, Parmalat, Warrnambool Cheese and Butter, and Lion Dairy and Drinks, they controlled a staggering 79% of the national milk supply.
79%. That's an enormous amount of buying power in just a handful of companies.
And at the same time, on the retail side, you had 2 supermarket chains, Coles and Woolworths, becoming totally dominant. They accounted for roughly 65% of all grocery sales in the country.
So you've got this incredible imbalance, right? A few huge consolidated buyers on one side and a fragmented, numerous group of producers on the other. It just set the stage for major price disruptions.
And it left farmers with very little bargaining power, basically none.
It became a classic David and Goliath situation, only David, in this case, often got completely crushed.
And then came the infamous $1 milk wars. That's what Aussie farmers call it.
Yeah, that term really stuck.
In 2011, Coles, one of those big supermarkets, made this dramatic move. They dropped the price of their private label milk, their store brand stuff, to just $1 per liter.
Just $1.
Yeah.
And predictably, Woolworths, their main rival, matched it almost immediately.
Of course. And the retailers, naturally, claimed they were absorbing the discount themselves. They framed it as, a win for consumers, a gift to Australian families.
Yeah, we're looking out for you.
But the article points out what we all intuitively know happens in these situations. Those artificially low retail prices, they inevitably flow back down the chain. They hit the processors, and ultimately they hit the farmers when new supply and pricing agreements get negotiated.
It's a classic squeeze play. The pressure just moves inexorably downwards, forcing producers to accept lower and lower prices for their milk, even while their own costs are often rising.
The impact was immediate and it was severe. The article documents this really clearly.
Yeah, the Queensland Dairy Farmers Organization, for example, they actually tracked it. They formally documented that 185 of their members collectively lost more than $767,000 in just the first 7 months of that price war alone.
$767,000. Just like that.
To put that in perspective, that's an average loss of over $4,000 per farm, just in half a year. For farms already struggling at that $2.46 an hour level we talked about, that's devastating.
It's not a small hit. It's a knockout blow for many individual operations. It pushed many who were already on the brink right over the edge into bankruptcy or forced sales.
It really highlights that just saying, let the market decide, doesn't automatically lead to perfect competition or fair outcomes for everybody.
No.
Instead, it can lead to these big, powerful players using their leverage to just squeeze everyone else down the chain, especially the primary producers who usually have the least market power.
It's a critical lesson, isn't it, about market structure and the unintended, often brutal consequences of just letting deregulation run wild.
It fundamentally changed who held the cards in the Australian dairy industry. And spoiler alert, it wasn't the farmers.
Okay, so we've talked about the money, the consolidation, the power shifts, but we often discuss structural adjustment in agriculture. Like, it's just numbers on a spreadsheet, right?
It's an abstract economic concept that just sorts itself out neatly.
But the article really forces us to confront the profound human costs behind those stats. Every single one of those 8,000 farm exits, that shocking 65% drop that represents a family giving up not just their income, but often their entire way of life.
It's generations of knowledge built up, family history tied to the land, deep community connections, a whole rural identity, all just disrupted, often permanently.
It's the breaking of a heritage.
And this raises that really important question about the social fabric of rural areas. The article gives this incredibly vivid and frankly poignant example of Strathmerton in Victoria. It's a tiny town, maybe 300 people. Its entire existence, its social life, its economy, it was all built around a Bega cheese processing plant. It had been the cornerstone of that community for decades, providing stable jobs, a sense of purpose.
Right.
Then, in 2022, Bega announces they're closing the plant. Reason given: operational efficiencies.
300 jobs, gone. Just like that, almost overnight.
And the immediate ripple effect was just devastating. The local primary school enrollment dropped from 110 kids down to 58 almost instantly as families with no work just packed up and left, looking for opportunity elsewhere.
Wow. Half the kids.
The town bakery, which relied heavily on the factory workers buying lunch and bread every day, it faced closure. It's just this chilling picture of a community being systematically hollowed out, its lifeblood just drained away.
One longtime resident of Strathmerton, they told reporters it felt like a death warrant for an entire rural community.
That's powerful language.
And what's really sobering is that this isn't some isolated incident, a one-off tragedy we can just dismiss as unique.
No, the article makes it very clear. It's a pattern. It's a painful story repeated across rural Australia in dairy communities, in Queensland, New South Wales, other regions that lost their processing plants.
When those plants, which are often the biggest employers, the main economic anchors, when they shut down, the whole local economy just starts to crumble.
Schools lose students, local businesses close up shop, the very social networks that hold a community together just start to fray.
It's not just economic loss. It's social and psychological devastation that leaves these really lasting scars.
And the social and economic spiral that follows these closures, it's incredibly hard to reverse.
Yeah. Young people, they see no future there, no vibrant community life, so they leave. Essential services schools, healthcare, local shops, they disappear because there just aren't enough people left to support them. It creates this negative feedback loop.
Property values collapse, making it tough for those who are left to even sell and move on if they wanted to. They get trapped in a declining area.
It's just such a stark reminder that agricultural policy, the decisions made way up the chain, they have consequences that ripple far, far beyond the farm gate. They impact the very social and economic structure of the communities that support the industry.
It's not just about farms. It's about the infrastructure, the spirit, the very fabric of rural life.
And when that unravels, like it did in so many Aussie dairy regions, it takes decades, maybe forever, to rebuild that lost social capital, that economic vitality.
It's important to say it wasn't all doom and gloom on every single farm, and the article does acknowledge some really impressive achievements. Right. Australian dairy farmers, despite facing these immense pressures, showed remarkable resilience, incredible innovation. They were forced to adapt or die, basically, and many adapted with impressive speed.
Individual farm productivity gains, they are remarkable. Average annual milk production per cow, it jumped significantly, right? From around 3,340 liters back in the mid-'80s to over 6,240 liters today.
It's a big increase. And they embraced precision ag, they put in automated milking systems, adopted advanced herd management software. These are all tools and practices that, North American farmers are also using. And in some areas, maybe Australia was even ahead for a while.
It shows that incredible drive to just survive and optimize when your back's against the wall.
But what's fascinating here is that while those individual farms got dramatically more efficient, more productive, this didn't translate into a stronger, more resilient industry overall. We saw that with the total milk production numbers falling.
Right. Instead, production got really geographically concentrated, didn't it? Just in a few key regions like the Murray-Darling Basin in Tasmania.
Exactly. And while that might seem efficient on paper, leveraging regional strengths, it actually makes the entire national supply incredibly vulnerable to localized shocks.
Like regional droughts, which Australia gets plenty of.
Or changes in water policy that can hammer feed availability, or even disease outbreaks that get concentrated in specific areas.
It's like having these super efficient engines, but they're all clustered in one place, running on the same fuel line.
Yeah, efficient individually, but incredibly fragile as a whole system when any single point of failure pops up. This concentration creates a systemic risk that just wasn't there when the industry was spread more widely across the country.
Puts all their eggs in fewer baskets, basically.
And this leads directly to another critical point the article highlights: the debt trap.
Oh yeah, this is huge. Post-deregulation, there was just an explosion in farm debt.
The average debt per dairy farm more than doubled in real terms. It skyrocketed from about $346,000 in 1999-2000 to over $861,500 by 2014-15.
Over $860,000 average debt.
And the article notes it's just kept climbing since then. That is a massive increase in leverage for individual farms, putting them in a much, much more precarious financial spot.
Can you imagine the psychological weight of carrying that kind of debt? Especially when your income stream is bouncing all over the place? Totally unpredictable.
It's a constant nagging worry. It affects every single decision you make on the farm.
And it raises that important question, doesn't it? When is debt good debt?
Typically, we think of good debt as investment in productive assets that will generate future income, boost efficiency, new barns, better equipment, land improvements.
Right, things that pay for themselves over time.
But in Australia, farms basically had to get bigger, more capital intensive, just to have a chance of surviving in that new, hyper-competitive, volatile market.
But the very market volatility they were trying to adapt to made it incredibly risky to take on the huge debt needed for that expansion and those upgrades.
It created this profound catch-22. You couldn't really compete without investing and taking on debt, but investing was increasingly dangerous because of the unpredictable market.
So for many farmers, that debt wasn't a strategic investment for growth. It was more like a necessary and often crippling burden just to keep their heads above water.
Yeah, often leading to foreclosures, forced sales when the market inevitably turned south again.
And tying into all this, the article touches on these really significant regional differences in how deregulation played out.
That's right. Queensland dairy farmers, for instance, they'd previously been protected by these milk premiums, essentially, higher, stable prices for fresh milk they supplied to the cities.
Right, a different market focus.
They got hit especially hard. Their farm numbers just plummeted by over 80%. From 1,300 farms down to just 240. New South Wales saw similar devastation.
80%, that's almost wiped out.
In contrast, Victorian farmers, who were already more focused on the export and manufacturing milk market, they initially saw some benefits, or at least weathered the storm better. They were already kind of geared towards global markets, lower cost structures, which made them somewhat more resilient to the immediate shockwaves.
And if we connect this to the bigger picture, what does it tell us?
It demonstrates pretty clearly, I think, that a one-size-fits-all policy just never works in a diverse agricultural landscape like Australia or Canada or the US for that matter.
Queensland and New South Wales farmers, they had built their businesses around a totally different market structure. Often smaller herds focused on supplying fresh milk locally under a regulated system.
When the rules of the game changed literally overnight with deregulation, they couldn't just pivot and suddenly become large-scale export-focused operations. Their land base, their existing barns, their management style. It was all wrong for the new reality.
Left them with little competitive advantage.
Exactly. This raises that important question about how these broad, sweeping policies impact very diverse farming operations differently. It really underscores the need to consider regional nuances when you're thinking about major policy changes.
It's a powerful argument for frameworks that actually allow for regional adaptation, isn't it? Something the Australian experience really lacked, tragically.
Okay, maybe the most troubling long-term consequence of Australia's deregulation, and this is something that should really send chills down the spine of anyone thinking about the future of dairy anywhere. It's a demographic crisis.
Yeah, this is scary. Less than 6% of Australian dairy farmers today are under the age of 35.
Less than 6%. That is simply not sustainable for any industry, let alone one as demanding as dairy. It's an industry just aging out, without attracting the vital young blood it needs to continue to innovate.
It's a profound warning sign for any ag sector that hopes to stay vital. If there's no new generation of farmers, well, who's going to produce our food?
And what stands out here is the direct link back to the debt trap and the price volatility we were just talking about.
Makes sense.
With those mounting debts, the sheer scale of investment you need just to get into dairy farming now, plus those unpredictable prices. Young people increasingly look at dairy farming and see, well, a dead end.
Even kids from established farm families, right? Who've grown up watching their parents struggle with all that uncertainty, they often decide it's just not worth the immense risk, the endless hard work for such an uncertain reward.
Who wants to inherit that kind of burden?
Yeah.
It also directly feeds into a severe hired labor shortage. Farms are perpetually squeezed on their margins, so they struggle to offer the kind of job security or competitive wages that would attract and keep skilled workers.
It becomes this vicious cycle of disincentive, leading to an ever-shrinking pool of potential farmers and laborers.
And this is where we really need to step back and appreciate what we have here in Canada.
Yeah, the contrast is stark. The article points out that our supply management system, despite all the criticisms it gets,
And it does get criticized.
it protects against these exact scenarios. While there's always debate and scrutiny around supply management, the system with production quotas, producer pricing, import controls to stabilize the market, when you look at it next to the Australian story, its benefits become incredibly clear.
Our farm numbers in Canada, they've been relatively stable over the years. There have been gradual, manageable change and consolidation, sure, but not a catastrophic 65% crash like Australia saw.
That stability allows for a much more orderly evolution of the industry, doesn't it? Not this brutal, forced contraction. It lets generational transfers happen more smoothly.
And if we connect that to the bigger picture, Canada's stability allows farmers to actually plan for the future because they have predictable milk prices.
That predictability is absolutely crucial. It lets you make rational, long-term decisions about expanding your herd, undertaking major barn upgrades, and, critically, planning for succession.
The article gives that great example of the Ontario farmer who's confidently investing in a new robotic milking system, expanding his quota as his share of the national production, and bringing his son into the operation.
That's a true generational transition, ensuring the farm continues, grows into the future.
That type of long-term planning, that generational continuity, it becomes incredibly difficult, maybe impossible, under Australian-style price volatility. When your future income stream is constantly in doubt, banks get wary, and the next generation gets understandably hesitant to commit.
And the technology factor plays a huge role here too, which might seem counterintuitive to some people.
Yeah, you'd think that intense competition would drive faster innovation, push farmers to adopt tech quicker, right? Be on the cutting edge.
But the article suggests the opposite actually happened in practice. When farmers are constantly worried about just covering costs next month or next quarter, they become incredibly conservative with big long-term investments.
They might adopt things with a quick short-term payback, sure, but not those deep, transformative capital projects that need significant upfront cash and take years to show a return. The risk is just way too high.
Exactly. Canadian farmers, because they have that price stability from supply management, they can take a much longer view.
They can invest in significant technologies, robots, precision feeding, comprehensive herd management software that might take 3, 4, maybe 5 years to fully pay off.
And they can do it feeling confident that their revenue stream will likely be there to support the investment, handle the debt repayment.
The Australian experience, conversely, it showed that only the farms that had significant capital reserves before deregulation even hit could really afford to take those kinds of risks.
Which put smaller or less capitalized farms at a severe disadvantage and probably held back industry-wide innovation overall. It raises that important question, doesn't it? How stability, rather than just raw hyper-competition, can actually enable and foster innovation over the long haul, leading to a more robust, more technologically advanced industry that really benefits from those advancements.
And one final key point from the article that highlights Canada's approach. Our supply management system, with its provincial marketing boards, it also recognizes regional differences.
Right. It allows for adaptation to local conditions, local market dynamics, while still keeping those national principles and overall stability.
It's not perfect, nobody claims it is, but it acknowledges that dairy farming just isn't the same everywhere across a huge country, which is a lesson Australia learned the hard way with its uniform top-down deregulation.
Okay, so after all that really deep discussion, what's the key takeaway for a farmer listening today? How can you take these frankly, sobering lessons from Australia and actually apply them to your operation, whether you're in Canada's stable system or dealing with volatile U.S. markets.
Yeah, this raises the important question. What can you actually do with this information on your farm right now, regardless of where you are?
Okay, let's break it down. Actionable insights.
First, calculate your real hourly wage. Don't just look at the bottom line on your tax return. Take your net farm income from last year and divide it by the total hours. And be honest here, the total hours you and your family truly put into the operation.
Everything. Milking, feeding, fieldwork, bookkeeping, fixing stuff. Every single hour that keeps the lights on.
Exactly. This gives you a brutally honest baseline. It helps you make decisions about labor efficiency, maybe income diversification. If that number makes you really uncomfortable, well, that's a powerful motivator for change.
Good point. Number 2.
Stress test your operation. Don't wait for a crisis to hit you. Run the numbers. Model what would happen to your cash flow if, say, milk prices drop 20% for 6 months straight, or if your feed costs suddenly jump 30%.
The Australian survivors, the article implies, had already built financial cushions. They had contingency plans because they'd lived through shocks before.
Right. Understanding your vulnerabilities before they smack you in the face is absolutely paramount to surviving them.
Okay, what else?
Invest in flexibility. Try to prioritize technologies, management practices that let you adjust relatively quickly to changing conditions. Maybe that means looking at variable cost feed systems instead of locking into fixed infrastructure. Or actively diversifying your income streams.
So you're not entirely dependent on that milk check? Maybe it's a small on-farm processing venture, selling direct, maybe custom field work for neighbors.
Agility is key.
Yeah.
In any market, really, but especially volatile ones.
Makes sense. Next.
Build relationships beyond the farm gate. This is crucial. Whether it's fostering strong relationships with your processor, keeping open lines of communication with your banker, or forging solid connections with other farmers, maybe through co-ops or just informal networks, your social capital becomes absolutely vital in turbulent times.
The article mentioned Australian farmers connected to co-ops or those with strong, trust-based processor relationships often fared better than the isolated ones.
Yeah, those networks can provide essential support, vital information, maybe even a bit of market leverage when things get tough.
Good one. What's 5th?
Document everything. And I mean, beyond just what you need for taxes. Keep incredibly detailed records specifically for strategic planning. Understanding your cost structure down to the cents per liter or per hundredweight gives you real power.
Power and pricing negotiations, right.
Yeah.
And it informs every major investment decision you make.
You can't manage what you don't measure. And you definitely can't negotiate effectively without hard data backing you up.
Okay, and finally,
Regional strategy matters. A farm in PEI faces different challenges and opportunities than one in Alberta or Wisconsin or California. Tailor your risk management, your investment strategies to your specific regional conditions, climate, local processing infrastructure, local market dynamics, labor availability.
don't just assume a one-size-fits-all approach will work for your farm, because the Australian experience showed it certainly doesn't work for an industry. Okay, those are great operational strategies. But specifically from the article's key takeaways, thinking bigger picture, what truly made the difference for those Australian farms that did manage to survive, maybe even thrive, in that incredibly challenging environment? What were the big shifts they made?
What's really compelling here is that the survivors didn't just get bigger, they got smarter, especially in how they managed their herds and their resources.
Okay, like how?
Scale smart, not just big. Yes, they averaged 534 cows per farm, way up from 168. But their success wasn't just about having more cows. It came from leveraging tools like genomic testing, using DNA to predict an animal's future performance.
Right, identifying the best animals early.
Exactly. That helped them improve feed conversion, how efficiently cows turn feed into milk by maybe 15-20%. The lesson for you, listening now, is clear. Start screening your replacement heifers using genomics. Identify those genetically superior animals that will be more efficient, healthier, and ultimately lower your costs in the long run.
Makes sense. What else?
Price volatility is real. Remember that stat, farmers losing 19 cents per liter overnight when markets crashed. This just hammers home the need to build in a significant buffer.
How do you do that internally?
Focus on robust feed efficiency programs like we just mentioned, but also genetic selection for resilience traits in your herd. Things like disease resistance, better reproductive efficiency. These are like your internal shock absorbers, helping insulate you, at least partially, from those external price swings.
Okay. Technology.
Tech pays off. The article showed that farms actively using things like precision feeding systems and comprehensive genomic data saw improved profitability, maybe 8 to 12% annually.
And that's not just about pumping out more milk.
No, it's about optimizing your inputs, minimizing waste, identifying potential health issues before they become really expensive problems. Consider investing in good herd management software. Get into genetic testing this season. These aren't just expenses. They're strategic investments in your farm's future viability and profitability.
Good point. What about the people side?
Youth crisis hits hard. We talked about that 6% under 35 number in Australia. Succession is a huge issue that can cripple an industry, leading to a loss of innovation, a loss of vitality.
So what's the action point?
Use stable planning tools, things like genomic breeding programs to show genetic progress, clear financial structures to create attractive, genuinely viable succession opportunities for the next generation. You need to show them a clear path to a sustainable future, not just a future of endless struggle and uncertainty like maybe their parents faced.
Okay, last one.
Market power matters. When just 5 processors controlled almost 80% of the milk volume, farmers inevitably got squeezed on price and contract terms. This just underscores the critical need for collective action.
Like joining co-ops.
Yeah, join cooperative purchasing groups to get better deals on inputs. And crucially, leverage your detailed genetic data, your production data, to negotiate better contracts with your processor. Data is power in those negotiations. It lets you prove your farm's value, your efficiency. Those are great points. The Australian experience, it really shows us what we stand to lose if we're not careful with our dairy policies wherever we are.
It also highlights something really important. Once you dismantle those regulatory frameworks that provide stability, that offer some degree of protection for producers, rebuilding them is incredibly difficult.
Yeah, the processors, the retailers who benefited from deregulation, they have very little incentive to give up their newfound market power. It makes re-regulation a really challenging uphill battle. We saw that with Australia's attempt at partial re-regulation with their 2020 dairy code.
It's a much weaker framework than what they had before, wasn't it? And
Yeah.
It only came after immense damage was already done. This whole deep dive, it just reinforces that the design of agricultural policies, it has consequences that ripple far, far beyond the farm gate.
Right.
It impacts not just individual farm profits, but the entire social fabric of our rural communities.
It fundamentally reminds us that stability, sustainability, sometimes they matter more than just chasing short-term raw efficiency figures.
It's not about abstract economics textbooks or theoretical models. It's about real farms, real families, real communities. Understanding this story helps us protect what works and fight for policies that support a viable future. So, here's a final thought for you to chew on, something to mull over after our deep dive today. Which aspect of Australia's dairy struggles, the massive farm consolidation and loss of farms, the crushing weight of mounting debt that pushed so many to the brink, or the devastating community collapse and the social unraveling we talked about? Which of those do you think poses the biggest potential threat to North American dairies in the years ahead? Which of these warnings resonates most strongly with your concerns for the industry right here?
And that's all the time we have for today's deep dive. For more articles and insights, be sure to visit www.thebullvine.com.
Don't forget to subscribe wherever you get your podcasts. Thanks for listening.
Thanks for tuning in to the Bullvine Podcast. Hopefully, these lessons from Australia's dairy journey give you some fresh insights for your own farm's future. Remember, it's never just about the numbers. It's about the people, the communities, and the smart moves we make every day. Until next time, keep your cows happy, your milk flowing, and your passion strong. Catch you soon.